Have you ever bought shares in a company just because a buddy mentioned it at a party? Or maybe because you saw this massive wave of hype sweeping across social media? Yeah, we've all felt that FOMO, that fear of missing out. But here's the reality check. Buying shares based on rumors or emotions, it's basically playing with fire. See, when you buy a share, you aren't just buying a blinking ticker symbol on a screen. You're becoming a part owner of a real, breathing business. So in this explainer, we're going to dive into exactly how to evaluate those businesses before you risk a single dime of your hard-earned cash.
Let's look at the stark contrast between emotional investing and fundamental analysis. On the left side here, emotional investing. That's buying blind, purely based on hype. Think about it like this. Imagine buying a house without ever checking the foundation, looking at the roof, or inspecting the neighborhood. You'd literally never do that, right? You could lose an absolute fortune. While on the flip side, we have fundamental analysis. This is the financial equivalent of hiring an inspector to do a deep dive on that house. Before you commit your money, you absolutely have to inspect the true condition and the core value of the business.
So, what exactly is fundamental analysis? Simply put, it's the process of figuring out a company's true underlying value. Instead of pulling our hair out over what the stock price is doing today or tomorrow, we're asking one massive overarching question. Is this company actually a strong business that's going to create value over the long haul? And we figure that out by looking right under the hood at its business model, its financial health, the people running it, and its potential to grow in the future. To do this right, our inspection has 5 parts. First, the foundation, which is the business and industry. Second, structural integrity, meaning the financial metrics. Third, the architects, or leadership and governance. Fourth, the neighborhood, covering risks and value. And lastly, the pre-investment checklist. All right, let's dive right into Part 1, Foundation, Business and Industry. The foundation of any good company relies on 3 main pillars. First up is the business model. You need to know exactly how this company actually makes its money. Honestly, if you can't explain in plain English what the company sells and who buys it, you probably shouldn't be investing in it. Next, look at their products and services. Is there real demand here? Are customers going to keep coming back for more? Companies that solve actual real-world problems just have way better long-term growth prospects. And finally, check their industry position. Are they sitting in a growing space like healthcare or tech? And do they have a competitive edge? The strongest companies absolutely crush their rivals because they have superior products, cheaper costs, or just fiercely loyal fans. If these 3 foundational pieces are wobbly, the rest of the house really doesn't matter.
Moving right along, let's check Part 2, Structural Integrity, Financial Metrics.
Now we're looking at the actual lifeblood of the business: revenue growth, profitability, and cash flow. Revenue is just the total cash a company brings in at the top before any expenses. You definitely want to see that number growing steadily year after year because it proves demand is going up. But, revenue alone isn't enough. You need profitability, which is the money left over after all the bills are paid. Consistently profitable companies are stable companies. And then, maybe the most crucial of all is cash flow. We're talking about the actual physical cash moving in and out of the bank accounts. A company can look totally profitable on paper, but if they don't have the literal cash on hand to pay their staff or their suppliers, the whole structure is going to come crashing down. So how do all those corporate numbers actually matter to you, the shareholder? Well, earnings per share, or EPS, tells you exactly how much of that total profit belongs to each individual share you hold. Obviously, the higher the EPS, the better. Then we've got the price to earnings, or PE ratio. This just compares the share price to that EPS we just talked about. A sky-high PE ratio could mean people are expecting massive growth, or, watch out, it might mean the stock is dangerously overpriced. Next up is return on equity, or ROE. This shows how incredibly efficient the management team is at taking your money and turning it into even more profit. And lastly, if you're a fan of passive income, keep an eye on the dividend yield. That shows what chunk of the profits they're paying straight back to you in cash. When you strip down a company's balance sheet, it really comes down to just 2 things. On the left side, assets. This is everything the company owns outright, like cash in the bank, office buildings, or heavy equipment. On the right side, liabilities. That's everything the company owes to someone else. Bank loans, unpaid supplier invoices, taxes, you name it. Bring it back to our house metaphor for a second. You wouldn't want to buy a house where the mortgage is way higher than what the place is actually worth, right? Same thing here. A financially solid company has assets that can comfortably, and I mean easily, cover its liabilities. To really measure that financial balance, you want to look at the debt-to-equity ratio and the book value per share. Look, almost all businesses borrow money, and carrying a little moderate debt is totally normal for funding growth. But the debt-to-equity ratio acts as a warning light to tell you if they've gone a bit overboard. If a company is drowning in excessive debt, that becomes a huge risk factor the minute the economy hits a rough patch. Why? Because the bank still wants those loan payments, even if sales dry up. Meanwhile, book value per share represents the value of the company's assets strictly after you subtract all those liabilities. It's an awesome baseline number to help you estimate the company's absolute rock-bottom core value.
Next up, Part 3, The Architects, Leadership Governance.
You can't forget the human element. It's absolutely vital. That starts with management quality. You really have to research the people pulling the strings. Do these leaders have a proven track record? Do they talk straight with investors when times are tough? A strong leadership team will steer a company right through a crisis, whereas a bad one will probably cause the crisis in the first place. Then there's corporate governance. That's just a fancy term for the rules that ensure honest reporting and ethical behavior. Solid governance protects you, the investor, from shady practices or outright fraud. Finally, peek at the shareholding structure. Who actually owns the biggest slice of the pie? Is it the original founders, big institutional investors, maybe a government? Knowing who holds the largest stake gives you a brilliant window into who is truly driving the company's major strategic moves.
Moving to Part 4, The Neighborhood, Risks and Value.
Remember, even a perfectly built house can lose value if the neighborhood goes downhill. Every company is dealing with external forces, so you have to ask, what are the future growth opportunities? Can they break into new geographic markets or roll out some killer new products? On the flip side, what are the company risks? Are hungry new competitors moving in? Are global supply chains getting snarled? What about new government regulations eating into their profits? And of course, you can never, ever ignore the broader economic trends. Even the most bulletproof company on the planet is going to feel the sting of rising interest rates, runaway inflation, or a sudden freeze in consumer spending. You've got to factor these neighborhood conditions into your strategy.
Okay, so let's say a company passes every single test we've talked about so far. It's an incredible business. Honestly, that still doesn't mean it's a great investment if the share price is way overvalued. You have to step back and ask, is this current share price actually reasonable when you look at its real financial performance? It's pretty simple. If you severely overpay for a great company, it could still take you years or maybe even decades just to break even.
And that brings us to our final section, Part 5, the pre-investment checklist. Before you can actually run through the checklist, you need the right data. Please stay far away from the rumor mill. The most reliable information is 100% public. You want to be pulling the company's official annual reports and their quarterly financial statements. Go ahead and visit the investor relations pages on the company's own website and always verify their announcements directly on the official stock exchange websites. Sticking to these exact, verified sources cuts your risk way down and ensures you're making choices based on cold, hard facts.
So let's condense this entire house inspection into 4 super easy steps you can start using today. Step 1. Truly understand the business model and the industry it operates in. Step 2. Crack open the books to evaluate those financial metrics, looking closely at profitability and debt levels. Step 3. Assess the leadership and governance, the actual humans running the show. And Step 4. Weigh the external economic risks and double-check that the current market valuation actually makes sense. Make it a habit to run every single stock you look at through this exact 4-step process.
Now look, no amount of analysis is ever going to completely eliminate risk from the stock market. That's just the nature of the beast. But looking at all these factors together gives you a remarkably clear picture of a company's true health. Doing this homework is exactly what transforms you from an anxious speculator into a confident, disciplined, long-term investor. Because at the end of the day, informed investing begins with informed research.
So the next time you get a hot stock tip from a friend or you feel that sudden urge to buy shares on a whim, I want you to hit pause, look at your portfolio, and ask yourself this one final, absolutely crucial question. Are you gambling or are you investing? Run the inspection, do the research, and make your money work for you the right way. Thanks for joining me on this explainer, and happy investing.